Gentlemen, thank you for standing by, and welcome to the Cai International Fourth Quarter 2020 Earnings Conference Call. At this time, all participant lines are in listen-only mode, so if you require operator assistance, please press star, then 0. After the presentation, there will be a question-and-answer session. To ask a question during the session, you will need to press star, then 1. Please be advised that today's conference may be recorded. I'd now like to hand the conference over to your host today, Mr. David Morris, Chief Accounting Officer. Please go ahead.
Thank you. Good afternoon, and thank you for joining us today. Certain statements made during this conference call may be forward-looking and are made pursuant to the safe harbor provisions of Section 21E of the Securities Exchange Act of 1934 and involve risks and uncertainties that could cause actual results to differ materially from our current expectations, including, but not limited to, economic conditions, expected results, customer demand, increased competition, and others. We refer you to the documents that Cai International has filed with the Securities and Exchange Commission, including its annual report on Form 10-K, its quarterly reports filed on Form 10-Q, and its reports on Form 8-K. These documents contain additional important factors that could cause actual results to differ from current expectations and from forward-looking statements contained in this conference call. Finally, we remind you that the company's views, expected results, plans, outlook, and strategies, as detailed in this call, might change subsequent to this discussion. If this happens, the company is under no obligation to modify or update any of the statements the company made during this discussion regarding its views, estimates, plans, outlook, or strategies for the future. I will now turn the call over to our Interim President and Chief Executive Officer, Tim Page.
Good afternoon and welcome to CAI's Fourth Quarter 2020 Earnings Conference Call. We are very pleased with the exceptional performance CAI achieved in the fourth quarter. Net income from continuing operations, which is effectively net income for our container leasing business, was a record $32.5 million. Adjusted net income from continuing operations was $31.6 million, 69% higher than Q3 of 2020 and nearly 200% higher than Q4 of 2019. Container lease revenue was also a record at $81.6 million, an increase of 10% versus the third quarter. Every aspect of our container operations contributed to this outstanding quarter and provides a runway for continued strong financial performance in 2021. Average CEU utilization was 99.3% in the quarter and currently stands at 99.7%. We invested aggressively in the fourth quarter, taking advantage of the unprecedented level of global container demand, and put in place $154 million of leases for new standard dry and refrigerated containers, with average lease rates well in excess of our fleet average. These new leases have an average lease term of 11 years. Since the end of June, we have put in place approximately $300 million of new leases and have grown our revenue-earning assets by 6%. In addition to leases for new containers, we renewed and extended leases on many older containers, with lease terms reaching up to 14 or 15 years, and in some cases even longer. These renewals were at rates that are very attractive relative to historical norms. Our average cash funding cost continues to decline, and as of the end of Q4 was 2.25%, a decrease of 38% as compared to the end of Q4 of 2019. During Q4, we saw a continuation of strong secondary sale market, with sales of $29.4 million generating gains on sale of $4.4 million. Demand for containers has been exceptional, and there are no signs of it abating. We expect the global container fleet to increase by more than 5% in 2021. We have a robust forward order book with $340 million of container purchase commitments through the early part of Q3 2021. Additionally, we are working with several of our large customers to provide takeout financing for their own container purchases. While demand remains strong, container manufacturers continue to closely manage their production levels and have been increasing prices, with current quotes for future production in the $3,500 range for a standard 20-foot dry container. Given the high container prices, we are being cautious and are focused on obtaining lease commitments from our customer to back future purchase commitments. As our Q4 results demonstrate, size is not a necessary determinant in achieving outstanding market success. We are nimble, we're selective with the deals we make, we focus on returns rather than market share, we micromanage our utilization, and we consistently demonstrate our ability to grow. ROE for adjusted continuing operations was 21.2% in the quarter and reflects the promise we made to prudently allocate capital to drive shareholder value. Not only did we deliver strong operating results in the fourth quarter, we also delivered on our commitment to return CAI to a container leasing-focused business by completing the sale of our rail business, freeing up the capital invested in that business. Even as we're investing aggressively in new containers, we enjoy a record level of liquidity, which allowed us to announce an increase in our quarterly dividend. Additionally, since the beginning of December, we have repurchased 639,000 shares, 3.6% of our outstanding shares, and have also announced that the board has authorized the extension of our share repurchase program by an additional 2 million shares. In conclusion, the results we have achieved this quarter provide an exceptional foundation for continued strong shareholder value creation throughout 2021. I'll now turn the call over to David Morris, who provides some additional color on our financial results. David?
Thank you, Tim, and good afternoon, everyone. Following the disposal of our remaining rail cars during the fourth quarter of 2020, my comments will be limited to the continuing operations of our container leasing business. We have enjoyed an exceptionally strong quarter with an increase in utilization and strong customer demand for both new and depot equipment, leading to a 10% increase in container lease revenue from $73.9 million in Q3 to $81.6 million in Q4. Net income from continuing operations, adjusted for the write-off of debt issuance costs and a one-off tax credit that I will discuss later, was $31.6 million for the quarter, or $1.76 per fully diluted share. As we mentioned in our earnings release, the run rate of our business exiting Q4 was robust. However, for reasons I will elaborate, we anticipate that our Q1 net income will be at or slightly below Q4. Container lease revenue in Q4 was a record $81.6 million. However, we expect revenue in the first quarter of 2021 to decrease slightly, primarily as a result of there being 2 less billing days in Q1 compared to Q4. Depreciation expense for the fourth quarter was $27.8 million, similar to Q3. We expect this to increase slightly in the first quarter of 2021, reflecting the increased investment in recent months. Storage and handling costs were $3.5 million in Q4 compared to $4.7 million in Q3. The increase in utilization between the quarters causing storage costs to continue to decline. As our equipment is close to being fully utilized, there are little in the way of additional savings to be made in storage and handling, and we would expect these costs to remain at a similar level in the first quarter of 2021. Gain on sale of containers was $4.4 million in the fourth quarter, compared to $2.4 million in the third, reflecting strong demand in the secondary sales market. While demand and prices remain high, our volume of available for sale equipment is low. As such, we expect gains on sale to return to their Q3 levels in the first quarter of 2021. Admin expense was $8 million in the fourth quarter, compared to $6.4 million in Q3. Several non-recurring items were included in both quarters. We expect admin expenses to be in the range of $7 to $7.5 million in the first quarter of 2021. It is worth mentioning the company's success in collecting receivables from our customers. DSO has decreased again from 45 days at the end of Q3 to a record low 42 days at the end of Q4. Our operating income from continuing operations was $46.7 million in the fourth quarter, an increase of 24% compared to Q3. Net interest expense, excluding the write-off of $2.3 million of debt issuance costs associated with the repayment of one of our old ABS facilities, was $12.2 million in Q4 compared to $15.4 million in Q3. The average cash interest rate on our outstanding debt is now 2.25%, compared to 2.52% at the end of Q3. Although we expect debt levels to increase due to increased investment, we expect interest expense in Q1 2021 to be in the same range as Q4. As reported previously, we disposed of our remaining railcar assets in December 2020. Although we recognized a loss of $25 million from discontinued operations during the fourth quarter, we generated approximately $33 million in cash as a result of the sale, increasing our year-end liquidity. Income taxes for the fourth quarter were impacted by a non-recurring tax credit of $3.2 million as a result of revaluing our deferred tax liability due to a change in future state tax apportionment caused by the sale of our logistics and rail businesses during the year. We expect our 2021 tax rate to be approximately 8%. The total book value of our container revenue earning assets at the end of Q4 was $2.4 billion, an increase of $99 million compared to Q3. At the end of the fourth quarter, we had total funded debt, net of restricted cash and cash held in variable interest entities, of approximately $1.7 billion, compared to approximately $1.8 billion at the end of Q3. As of today, total cash and liquidity available under our credit facilities is approximately $250 million, the highest level in our history. This liquidity is available for investment or return of capital to shareholders. That concludes our comments, operator. Please open the call for questions.
Ladies and gentlemen, if you'd like to ask a question at this time, please press the star, then the number 1 key on your touchtone telephone. Again, that is star, then 1 if you'd like to ask a question. To withdraw your question, press the pound key. Please stand by while we compile the Q&A roster. Our first question comes from Michael Brown with KBW.
Hi, Tim, David. Good afternoon.
Hi.
So, wanted to just start with some maybe additional comments about the operating environment here. Clearly the demand levels are certainly still elevated. Supply is still relatively I think rational was kind of the word used in the prepared remarks. You've got some orders extending out beyond the second quarter. So I guess my key question that I'm trying to understand a little bit better here is just how long can this type of an environment last? I mean, it's certainly, I hate to use the term that this time is different, but this cycle seems to be elongated here. So I'm just curious how you're thinking about how this plays out into the end of throughout 2021 and in the second half of 21 specifically.
Well, I think you have to put in perspective where we were to answer that question. Coming out of the second half of 2019, there was very little container production. Similarly, in the first half of 2020, there was very little container production. So this ramp up of production that we've seen in the fourth quarter of this year really comes on the heels of container fleets shrinking over the 12-month period, second half 2019, first half 2020. So in that context, a lot of what's been going on is really replacement of fleet just to kind of stay even. So Drewry's just recently updated their container forecast for 2021, and their expectation or their estimate of container fleet growth is 6.5% in 2021, and then a little bit of a moderation in the years after that to 3.5% or so. Of course, the 3.5% growth in 2022 and each subsequent year is on a bigger base, so it's still relative to prior years, it's still a lot of additional TEU being produced. In terms of, we think that based on Drury and based on conversations we've had with customers, we're not anticipating much of a decline in the demand for containers, and you have to also take a look at we're starting to perhaps see coming out of the light at the end of the tunnel coming out of COVID as vaccines get more widely distributed, and while there's a lot of speculation that demand might fall off because people consumers will switch from spending money on home improvements and this and that and the other thing to maybe discretionary travel and the like. You have to remember that there's a large portion of the population that's still unemployed, and they're certainly not unemployed and underemployed, and they're certainly not consuming at levels that would be anywhere near what one would consider to be normal. So as I believe as time goes on, just the fundamental growth in the economy, plus all the stimulus that's going to happen in the U.S. and it's happening in Europe, we're going to see strong consumer spending for some time, and that's going to continue to drive container growth. On the pricing side, the manufacturers seem to have little or no interest in accelerating container production. They're more focused on maintaining high container prices. So I think you're not going to see a flooding of the market of containers. You're going to see a very measured response by the manufacturers to control kind of the supply-demand balance that exists, the tight supply-demand balance that exists today. So I don't know if that answers your question, but fundamentally we don't, as we said in our prepared remarks, we don't see the market slowing down this year. Could there be a little slowdown in the fourth quarter because it's usually a little slower? Possible, but I don't think it'll be significant.
Yeah, thanks, Tim. That's really helpful color. If we switch gears to capital return, you guys are obviously very aggressive on the buybacks and returning capital to shareholders. You've got the increase in the authorization. Obviously, just given how elevated the fourth quarter and the first quarter were, how should we think about what that pace could be now going forward? Just trying to figure out if those are relatively good guideposts for the balance of 2021, or how you may balance that lever here with obviously a very strong CapEx environment. Thanks.
I think fundamentally we're very interested in, and we have the liquidity to return capital to shareholders. I can't predict what the market is going to be able to to let us actually execute. There are obviously limits around how much we can acquire at any given point in time, but fundamentally we think it's possible for us to be investing at the kinds of levels we've spoken of and return significant amounts of capital to shareholders. We're going to generate a lot of additional liquidity at the earnings pace that we expect for the year. We'll be generating pretty significant liquidity every quarter on top of what we already have. So we think fundamentally, as I said, we certainly have the capability to do it. Again, what the market allows us to actually execute is another question.
Okay, great. I will leave it there. Thank you for taking my questions.
Our next question comes from Bob Napoli with William Blair.
Thank you. Good afternoon, Tim and David. Congratulations on an incredible year. Obviously, tell two halves and just crazy, unbelievable times, and you guys managed it quite well. Just, I guess, so your comment, Tim, very well understood that earnings would be down, flat or down slightly in the first quarter from the fourth quarter. Obviously, you're getting the benefit of putting on leases at higher rates, offset by 2 shorter days, and not as much gain on sale as you have very little available. But how would you think about the second quarter with the extra days? Would you expect earnings to grow sequentially in the second quarter, given you still have a fair amount of assets coming on board here in the first quarter?
I mean, we would expect, second and third quarters to grow sequentially. There's one additional day in the second quarter, and then there'll be another additional day in the third and fourth quarters. We do have additional assets going on lease, so that will, drive some incremental revenue. It's hard to predict what we will have available for to actually sell in the market, because at 99.7% utilization, right. And that's a CEU utilization. If you actually measured it in terms of TEUs or units, it's actually higher than that. It's 99.8%. So there's just not very much to sell, and we're not expecting to see a lot of turn-in of equipment, other than unless it's really old and probably really beat up at this point. So the available product that we're going to have is going to be, we think, is going to be pretty limited for some time. But absent that, we should generate more. Every day we have more lease revenue because we're putting more assets on lease. So we would expect as the second and third quarter to sequentially grow off the first quarter.
Great, thank you. So it sounds like it's a pretty good earnings number for the year, mathematically, versus current expectations.
Yes, we're expecting a pretty significant year.
Right. So you're looking at $6. I mean, just mathematically, if you're flat and then grow over. Okay. All right. We can all do the math on that. Let's see. Just the lease rates, and looking at your chart, the leases that are coming off lease in 2021 look to be a fair amount, probably below current lease rates. As those get released, are you able to release those at the current lease rates? So essentially you expect the yield on containers to move up quarter over quarter over quarter?
When the older equipment comes off lease, you typically don't get a lease rate that's at the rate for a brand new piece of equipment. You're going to get something in depending on what the rate was, you'll get something in between somewhere, and it just varies based on the lease and who the customer is, and are you rolling that conversation in with additional new equipment leasing. So it's hard to predict on any one specific lease what the actual outcome is, but as a general rule, we certainly don't expect it to see any decreases in lease rates as leases renew, which by historical standards would be very unusual.
Great. Thank you. And then just a question on competition. Having been through a number of these cycles, occasionally, we've seen, there has been periods where you have, 5 or 6 years of good times of a really healthy environment, but you can have 1 or 2 competitors that decide to go for market share that throw a wrench in things. And clearly you're being disciplined. I think your competitor that reported this morning is very disciplined. Are you seeing any signs? Is there anything concerning you on the competitive front at this point?
I would say generally not. For starters, there's just not production available for any one person to go crazy. So, the factories themselves are behaving differently than they have in the past, and they're closely monitoring the supply-demand balance, and they don't have any interest in increasing production at the expense of price. So I think that's kind of a new dynamic in our industry, and I think that's going to stick.
Okay. I guess that quick numbers question. What was the ending share count?
David, what is it, 17,560, something like that?
Yeah, you've got it pretty much spot on, 17,563.
Great. Thank you very much. Appreciate it.
As a reminder, ladies and gentlemen, if you'd like to ask a question at this time, please press the star, then the number 1 key on your touch-tone telephone. Our next question comes from Dan Day with B. Riley.
Hey, afternoon, Tim and David. Thanks for taking my questions, and congrats on a really strong quarter, really strong outlook. I guess first question, just a quick modeling one on administrative expenses on that line with the other businesses going. Is that like $8 million-ish a quarter number, a good benchmark to use going forward?
Yeah, I think $7.5 million.
Okay, cool. Thank you. More of a higher level question. Average lease duration, I think you noted at 11 years. Trading this morning said 10 years. Kind of what's driving this? In the past you had kind of said like 6, 7, 8 years is pretty typical. What's driving the average lease durations up 3, 4 years compared to what they were?
I think it's a combination of things. One as the owner of assets, as the price has accelerated rapidly, we want to make sure that we limit our exposure to getting equipment back, and container prices maybe being lower in the future, impacting our ability to lease that equipment out at the same rate. So we have been for a long time very focused on trying to get as long a lease term as possible, full life cycle leases we like to refer to them as. So that's a driver, but also the container lessors. I mean, our customers are also some of them also are looking at the same thing. They want containers. They want to know they're going to have the container for its full life cycle. They want to fix the price. They know that sometimes they want to fix their rate. They know that sometimes prices might be high, so prices might be low sometimes. So it's a portfolio approach, and that they see value in not returning equipment multiple times during what would normally be a container's life to chase a little bit lower per diem. I think they have done the calculus, and it's less costly to hang on to the equipment, even if it's at a higher lease rate, than it is to return it and incur all of the upfront costs associated with returning equipment. So I think it's a combination of our desire to minimize risk and the shipping companies' desire to minimize their repositioning and end of life, or not end of life necessarily, but repositioning and equipment turn-in costs by having just one turn-in at the end of the container's life.
Got it. Thank you. That's helpful. And then one more just on, I've heard some commentary on new container prices around 3,500 a TEU. How do you see that evolving from here? Like, do you think we've sort of hit a top? How high can those new container prices go, and sort of what should we be looking for before that starts to roll over?
Well, it's hard to get into the, ultimately the Chinese manufacturers are controlling what production levels are and what container prices are. It's hard to say. I wouldn't try to predict that. We've seen a maximum on this price, but I just don't know. To be honest, it's all a function of what supply and demand is, and ultimately, if a shipping company has freight to move from China or someplace in Asia to Europe or the United States, and they need containers to do it, and they don't have those containers, and they're not readily available, that's a recipe for rising container costs.
So it's safe to say all the manufacturers are running full out, and there's sort of no way they can just increase production from here. They're sort of at their
I wouldn't say that they can't increase production. I would say that they are managing their capacity to maximize revenue and profitability.
Got it. Okay. Appreciate you taking my questions, and I'll turn it over.
Okay.
We have a follow-up question from the line of Michael Brown with KBW.
Great. Thank you for taking my follow-up. So Tim, CAI is now a pure play container leasing company. You're generating significant cash flow. You're sitting on high cash levels. The organic growth is certainly good. The outlook seems very good there, but somewhat constrained here. So just curious, now that you've kind of gotten some of the cleanup activity behind you, would you actually look to make any acquisitions in the space? Maybe something in the private side of things, or conversely, do you see opportunities to actually partner with another company?
I think looking at our ability to acquire somebody is certainly a much more realistic option for us, given where our share price is trading, the liquidity we have. So it's certainly on the menu of possibilities. There aren't a lot of options, but certainly we would be interested in looking at anything that might be available. That's about all I can say about that.
Okay, great. And then just one more question for you, Tim. And I understand this one is a little bit maybe a little more sensitive question, but I noticed you still have the interim title, and has been a while now. So just kind of curious on what the board's thoughts are on that, and the expectation there, because clearly there's still some uncertainty in the C-suite. So just curious if there's any thoughts or comments you can share on that. Thank you.
I think that the status is pretty much unchanged. The board's obviously quite happy with the performance. My own personal objectives are to certainly help with an orderly transition, and regardless of how long that takes. So we're in a position to do the best thing for the CAI shareholders, but at some point it's time to bring in a new era of leadership to the company.
Okay, great. I appreciate the color there, and I will say that investor sentiment certainly echoes the board's positive comments as well. So thank you for sharing that. That's it for me. Thank you for taking my follow-ups.
As a reminder, ladies and gentlemen, if you'd like to ask a question at this time, that's star, then 1. We have a follow-up question from the line of Bob Napoli with William Blair.
Thank you for the follow-up. Just on the earning assets, so Drewry's outlook for 6.5% growth with container values much higher than I think that's a unit, not a dollar number, if you would. What are your thoughts, Tim, on there, or David? Any commentary on the ability to grow the earning assets? I think you had about $2.4 billion of container earning assets at the end of the quarter.
I think we're going to. We expect to grow our fleet on a TEU or CEU basis, and along with that, grow the assets will grow in value. The assets that are falling off are at pretty low value, particularly relative to where we are today with container prices. So I would expect a continuation of revenue earning asset growth. As long as the market stays like it is today.
Yeah.
With utilization where it is, there's very little coming off. So, the little bit of decrease in asset value really is coming from depreciation, not from asset disposition.
Have you seen any new entrants, given the really favorable environment that? I'm not sure it's easy to stand up a global container leasing business that quickly, but have you seen any? We haven't seen anybody.
We haven't seen anybody, attempting to, greenfield a container leasing company.
Right.
It is not easy. It's particularly not easy right now because it's very difficult to get production from the manufacturers. So, as it is, the established players are constantly jockeying for position to get container production. So the ability for any potential new player to come in and do that would be very difficult. There are financial players who will finance containers here and there, but generally the limiter there is how much credit exposure somebody might want to any individual shipping company. So we haven't seen a huge amount of new financing sources or certainly no new container leasing companies of any consequence in this really good market.
Yeah. Thank you. Just last question. The depreciation during the quarter, was that a clean container depreciation number? So if we looked at that number relative to the average earning assets, that's a reasonable run rate?
Yes. Yeah, this is just continuing operations, just standard stuff. So good for a run rate.
Great. Thank you. Appreciate it. Congratulations.
Thank you.
Thank you.
I'm showing no further questions in queue at this time. I'd like to turn the call back to Tim Page, Interim President and Chief Executive Officer, for closing remarks.
I'd like to thank everyone for listening in and thank you. Goodbye.
Ladies and gentlemen, this concludes today's conference call. Thank you for participating. You may now disconnect.